Welcome to the STARS program, seniors taking active roles in society. And now, here's your host, Anita Finley.
Life insurance is very mixed up. You know, I'm so glad that I have an expert, Rob Colson, who guides me and tells me, because I'm so confused. Every time I see another life insurance ad, I always say to him, so what about this? And he says, okay, let me tell you about this. But you have a lot of news to talk about this time, Rob. Why don't you tell our listeners what you're really so hot about?
Well, thanks again for having me again, Anita. It's always nice to sit down and talk to you and your audience. Really what I want to talk today about is something that's all over the news today. There's articles, there's news reports, there's 60 Minutes talking about it. More recently, the Wall Street Journal actually wrote an ad last month, an article on really what we've been talking about over the last few months, which is insurance costs, what's happening to people's policies. Insurance has changed, the market's changed, but more importantly, what's changed? Interest rates have changed. So what does that mean for a person who's bought a policy 5, 10, 20 years ago? Well, as you probably know, when you're in the housing market looking for a mortgage in the 80s, buying CDs at the bank, you used to get a lot of return on your money because interest rates, especially what the long bond yields are, the dollars based off is called the US Treasury. US Treasury is what's called safe money. It's AAA rated money backed by the US government. Back in the 80s, those funds, the U.S. Treasury was paying over 15%. As of 2012, we hit a historical low on the Treasury. We went as far as 1.40. Yields are now approaching 1.5%. So what does that mean? What that means is the safe money that insurance companies were previously investing their money, the whole policyholders' money. It was easy for them to guarantee returns based on longevity and over 10, 20, 30, 40 years of somebody holding a policy. What's changed? Imagine buying a stock at 15 and it's now at 1.5 or 2. That's what's happening to the interest rates. So what happens to the interest rates, the insurance companies, when they projected what the cost of the insurance was 5, 10, 20 years ago, those numbers have now changed. Because they can no longer make the guaranteed money that they were projecting on people's policies. And at that point in time, illustrations were showing guaranteed rates of 8, 9, and 10%. And insurance companies felt very safe doing that because the yields on the treasuries were over 15%. Well, now they're looking at a market where they can't get guaranteed money of even 2%, and yet projections are still on old illustrations at 7, 8, 9, 10%. So
the insurance companies are still cleaning up.
The insurance companies are trying to catch up, Anita. And as a matter of fact, what this recent article, I'm going to quote it very quickly on the Wall Street Journal article, said, last month, Transamerica sent 26,000 customers that have aged policies, letting them know that the premium payments projected on the minimum payment that they have been projected over the last 5, 10, however long they've had the policies no longer exists. So what does that mean? That means that they are going to have sticker shock. That means the next annual statement, semi-annual premium payment notices, all of those things are going up, and you might want to sit down when you hear this. They are quoting, and I've seen this in the last 2 weeks in my office frequently, between 200 and 400% increases in people's policy premiums. And let me give you.
And they're allowed to do that, Rob.
They are, because the fine print on a lot of these policies stipulates that that's what they're allowed to do. And let me explain how this works. And a universal life insurance policy works very simply. You put in X amount of funds, it gives you flexibility, and that account has a balance. What the insurance company extracts from that, or it takes out as an expense, is the initial cost of insurance. And what they will credit back from that account value is any growth or interest that they have on that money. Well, imagine putting $10,000 in an account at 15%. That's, you're making over $1,000 a month, simple interest on that account. Well, now extrapolate that forward to today's numbers in 2015. That same $10,000 wouldn't even get you $100 a month. So the insurance company's accounts, and it's not their fault, it's the way the world's operated, interest rates have moved. The problem is they haven't moved fast enough. So what's happened is what the articles are alluding to is there's an imploding of people's policies, especially ones bought in 1980s, 1990s, early 2000 when interest rates were still high. The insurance companies don't have the ability to make the money inside the account values. The insurance costs as people get older increase, and the offset isn't there. So the cost of insurance has increased, but the interest and the growth in the account values is not caught up or kept up with the cost of insurance increases. So what we're seeing is across the board, a lot of people who have been paying $1,500 every 6 months, $3,000 a year on a $100,000 life insurance policy. They bought that policy 15 years ago. Now they're in 2015. A lot of these people are in their 70s, early 80s, and they're getting these statements that I just talked about in the mail.
So if they can't afford it, they'll drop it?
They have options, and I'll discuss that in a minute. But just to give you a real-life scenario, those semi-annual payments were coming in at $1,500, just say for 6 months. So that's $3,000 per year. With the increase in the cost to carry that policy through to somebody's potential death, could be 95, 100, who knows, the cost of the insurance has gone up so much that $3,000 a year payment has gone up to $12,000 per year on a $100,000 life insurance policy.
Oh, no, they can't.
So they do. So what's happening is we're having people come in the office, give us these statements, show us illustrations from a year or two ago, and those illustrations clearly show that $3,000 a year would have carried that policy. The new annual statement comes, they get a nice letter from the carrier, and the carrier says, now instead of your $1,485 semi-annual payment, you owe us $5,975, which is a semi-annual payment. And these people are now looking at it, and they're in their retirement. They're on Social Security. A lot of them don't have a lot of extra money. They're not able to pay these premiums. So they're coming to us and saying, Robert, what are our options? And then actually, if you go back and look at that Wall Street Journal article, they talk about lots of options you can do. The very first option you should always do is call your insurance company. You should call your insurance company. You should ask them to give you an illustration.
That's what you did for me.
Correct. And you can do that on your own. You can do it with us. We're more than happy to assist. That's what we like to do. But that should be the first thing you should do. You should get an advisor. You should call us at US Insurance Auditors. You should have us work with the company. We can pull illustrations, and we can show you exactly how much it's really going to cost to carry that policy through what we call maturity, which is the end date of that policy. At that point, we can examine other options. And what are those options? Those options today are we may be able to renegotiate with the insurance company. And this is taking into retrospect that you don't want to pay $1,000 a month for a $100,000 life insurance policy, or you simply can't afford it. The options could be we might be able to get a reduced paid-up death benefit for you.
So you get a reduced paid-up death?
Yes. Some companies would they'll let you do, rather than continuing paying a payment you cannot make. And they all do not do this. Some will. They'll maybe allow you to reduce the death benefit to $75,000 or $50,000,
and then not make any more payments.
No, but reducing the cost of what you were primarily paying before. So instead of having to pay $1,000 a month, you're still at your $100 a month or your $200.
I see. You just don't have as much, but you still have some life insurance.
Correct.
So that sounds pretty good.
So that's option one. You can reduce the death benefit. That's one option. Another option you can do, you may be able to, if you're still healthy, you're under 85 years old, and you still have maintained good health, you may still be insurable. So if you still have an estate need, a family need, you want to leave the kids, the family some money, and that's still your intent, we may be able to find you a similar or exact same policy at a much, much lower cost.
Because you're starting now with this, what the finances world is today, right?
Absolutely correct.
So what you did, then they could give up the other policy and then get the new one.
That's exactly right. Now,
is that really, you find that?
Oh, we do all day long. We really do, because there's a certain population that another scenario is available. Let me discuss that as well. We've talked previously on other shows about life settlements. The Wall Street Journal actually has that as their fourth bullet point for people that have run the course. They've already called the company. The company's outlined you definitely owe that much in premiums. They've crossed number 2. We cannot get a reduced paid-up death benefit for them. Their third option comes available, and they might be on the edge. They're insurable, but we still might have a buyer for the first policy. Now why would they want to do that, Anita? Well, let's say we have a hypothetical situation of that same policy that's $100,000. The guy's premiums have gone from $3,000 a year to $12,000 per year. He's still relatively healthy. We can possibly, and I'm not speaking on an underwriter's basis, we shop all the carriers. So that gives us an availability to look at different companies' underwriting, and everyone has a different way of writing their insurance. What does that mean? Some companies, if you quit smoking 2 years ago, they call you a non-smoker. Other carriers, if you don't smoke for 5 years, they still consider you a smoker. So now,
so you know all that, right? That's what your business is.
That's exactly what our business is an independent broker using all the carriers. So what does that mean, Anita, real simply? We can shop for possibly a cheaper policy for you. Not a cheaper policy, a cheaper premium for you. And we may be able to find a buyer for the first policy. Now, how does that happen? Well,
before you tell us, just hang on, because I want everyone's saying, so how do I call him? I got to give him the information. You are listening to Rob Colson, and Rob is the owner of US Insurance Auditors, LLC. And the phone number to call him is 954-597-6430, 954-597-6430. And I'm going to give you a website because it's a great website. You can go on there, see a lot of the things he's talking about, what he can do for you. It's called usinsuranceauditors.com, usinsuranceauditors.com. His name is Rob Colson, and you really ought to consider doing this. This is wonderful information. I have to say this. I've known a lot of insurance people, but I have been so impressed with Rob Colson. He's been doing this for many, many years. He has great integrity. You can read his article on page 9 in Boomer Times. He always does something that's very interesting. This last one was long-term care hybrid products give buyers more options. It seems that you really love your clients because you have this. It's like almost a potpourri of things that you can offer them depending on what their needs are.
That's exactly right, Anita, and we're in a unique space because there's not many people out there that do the different facets of what we do. And what does that mean? We're not in the business to, sell life insurance to people regardless of their needs, their wants, or what have you. We believe everyone's situation is different, and there's no right or wrong answer many, many times on these situations. We have to do a lot of work to figure these processes out. A lot of people call us up on the phone. They've heard me on the radio, and they say, "Robert, how much is my policy worth? I have this much. I need to sell it." Or, I don't want this anymore. What's my $500,000 policy worth? Well, we don't have crystal balls. So unfortunately, the quick answer is never the right answer. It takes a little while for us to discover the real answer. And the process is kind of simple. It's a simple application. Let me explain that a little bit because I think people are a little bit apprehensive when we talk about a life settlement. And people feel like we are actually taking something from them when in actuality we're giving them something. So we take an unwanted asset, which is a life insurance policy, that on many occasions people have outgrown them. Kids are out of the house. They don't need that money to offset mortgages anymore. They're in their golden years in retirement. And that money that they're putting into these insurance policies that are imploding or exploding on the upside premium side for them, those monies can be used for other things. And that's really what we're in the business for, because as you get older, Anita, as you know, your needs change. Your needs aren't the same as they were when you're 40 or when you're 50, 60, and certainly not in 70 and 80. Our risk tolerance changes, and so does our ability to fund these things that we were paying for over time.
Is this a good time for me to say, of course, I met Rob because I was talking about a life settlement that my husband Bill and I did. And we had a very large insurance policy, and we wanted cash. We wanted money. So we did sell it. And we did get a nice chunk of cash, and it's wonderful. And so I guess what it is, and people have bought it, and though now the owner of it, and if something happens to Bill, it's his policy, then they get the difference of what it was. So it's really a win-win.
It really is, because the amount of insurance that goes expires, surrendered, or lapses each year is over $30 billion.
Amazing.
So many of these policies people have paid into for years and years and years. They're getting these statements.
Right.
They're saying they're getting sticker shock. They're looking at a bill that was $3,000 a year, now it's $12,000 a year, and they're saying, I have no options. I'm just going to let this thing go, or I'm going to call the insurance company and take my account value because I see there's $6,000 left in this policy. That's the worst possible solution you could ever opt for.
Because you're leaving a lot of money on the table.
You are, because the average life settlement today is returning 4 times the cash value of a policy. The insurance companies today, a lot of states have adopted rules and regulations actually requiring the insurer to recommend a life settlement appraisal prior to people surrendering the policy.
But I have to say that I love talking to you because it was at the time I did not know you. We did not use you for this. It would have been wonderful to find someone like you. It was very hard to find someone to do this. There are a lot of insurance people who don't understand it. They don't have the connection. So my advice to our listeners, if you like any of this, you need to call Rob Colson because he understands life settlements better than most people. Please call him. And if it isn't right, the life settlement, he'll figure out something else. But you will be able to get cash out of your policy somehow.
Yep. And let me touch on that a little bit too. People are probably sitting there, the power of the internet. They think they can Google and get all the greatest ideas in the world. Well, here's what happens. People go into this without a broker like us. And what they do is they Google life settlement. I want to sell my life insurance. I can't afford my life insurance. And what you're going to find is there is one company. I'm not going to say their name on the radio. But there's one company that works directly with the public. But here's what happens when you go with one company. It's like going to buy a car today, a Honda, a Toyota, going to one lot, seeing the sticker, telling the salesman to go write it up. I'm taking it right now. You got the car. There's no doubt about it. You really think you got the best deal on the car? I highly doubt it. So what does that mean? What does a broker do that you can't find on Google? Well, you can find us on Google, but what we do is we work with all of the institutional buyers. Instead of one buyer, we work with 20 to 25 institutional buyers, all licensed. And what does that do for the client, the customer? Well, our job as a broker, legally and fiduciary-wise, is to guarantee the highest bid on your policy. So our job is to work with that one company that also works directly with the public, but also 20-plus other lenders. So what our job is to make sure that first offer is never the best offer. Well, our job is to increase the offer to make sure the client customer gets the highest offer available in the market. Another thing I want to add today is this business is 100% transparent. So there's no more hidden fees. Everything is up front.
There were?
Yeah, there were before. There were hidden fees before. Years past in this business, there definitely was. The business has really come full 360. Department of Insurance regulates it heavily, and every transaction is transparent. So the client customer gets to see every offer that comes through, gets to see how we increase the offer. So let me give you a quick example how that works. Let's keep with that same $100,000 policy. And let's say the person's 75 years old and good health. The first offer in the policy, I'm using general numbers, not using any real numbers here. Let's say that the first offer comes in from company A and it's a $20,000 offer. Okay? Our job then is to work the 25 other institutions to increase that offer. Now, what does that mean? What transparency means, I can already say to the other buyers, I already have $20,000. Well, what do you need, Rob, to make it happen? Well, that's not my job. My job is to have you put your best foot forward. So what we do is we cause competition, we cause a real market, and we cause a very good market for the client because we guarantee that we will get the highest deal out of that policy that anybody can because we've shopped every car store on the street. We've stopped at every Toyota dealership on the street, and we can guarantee you, Anita, that we have the best price for you.
I understand that so much. Actually, we're in right now. We're doing something with a piece of real estate we have, and that's what the broker's doing. He's putting out. He knows what he has, and he's going out there to get more if he can. So that's a great thing that you're doing, and I know that's true because they did that with the policy that we had. They did shop it, but it was very hard. There aren't a lot of people doing what you're doing, not credibly. And something I have to tell, I know Rob enough. When you phone that number, he's gonna call. He's gonna answer, and you're gonna get the service that you want. You know, a lot of people sell insurance, but you buy the policy and that's it. You never hear from them. You know, I have some other policies and I never hear from anybody, ever. Do you call your people back?
We absolutely do. I do on a quarterly basis minimum to all of my clients.
But I'm
and
right.
I do an annual review.
I'm right.
You are 100%
Become
right.
orphans.
And I want them to call me. I want to do annual reviews. I want to do that. Because if I can replace something for current clients too, we do it all day long. Because the end of the day is, my job is to give you the best coverage at the lowest price.
Well, that's why you're successful, because then people keep coming back to you, refer people to you. And that seems, I don't know why that's a fallacy in the insurance business, that once they sell a policy to someone, you rarely hear from them. That's so strange.
It is. And there are a lot of advisors and insurance people that are just missing the boat. And they're mainly concentrated on one faculty of what they do. A lot of insurance agents are either health insurance agents, they sell Medicare. Then we have the life guys that are planners. And then we have accountants that think they're planners too. And you go to your accountant, he wants to do your taxes, do your whole investment portfolio. Well, that's great. But there's a reason there's specialists at the doctor's office as well.
Yeah, that's true. Well, you certainly hit on something very important. And I did hand Rob something because I get a magazine called Cure for people with cancer. And, you know, people who are in very serious illness, you probably know already, hopefully, that you can get that money out to take care of caregiving and all that. But there might be other things. Maybe you have some kids that are really down on hard times and it's breaking your heart and you don't know what to do. And you say, all I have is an insurance policy. Well, Rob can take the insurance policy, maybe keep it. As you said, you could reduce the final, you know, if something happened to you and you die. And yet, in the same token, you'd be able to use some of the money now to help your family.
You hit the nail on the head. A lot of the people that come to us on a first appraisal come to us, hand me the policy. I ask Mrs. Smith, can you tell me the primary reason why this policy was bought in 1988? 9 times out of 10, the answer is, I have no idea. I think
really?
Absolutely. I think my husband bought it. My kids are all in their 40s and 50s now. But Mrs. Smith, are you still making payments on the policy? Of course I am. I get a premium payment. I pay it. So many, many, many times we could sit there and offer them so many different opportunities. That could be stop continuing to pay the insurance company who have a fully funded policy. 2, do you have needs for this policy anymore? 3, through our discovery process, we figure out how is that person doing on a personal financial basis. Many people today, and this is not news to anybody, are struggling to pay their bills. As you get older, there's not a lot of other ways to make income these days. So a lot of times we can take an unwanted, unneeded asset, an insurance policy, take that and put it into something that person may want, a long-term care policy, an annuity.
Oh, wait. You just hit on something fabulous. Long-term health care.
Absolutely.
And can you help them with that?
Absolutely. We do all those products as well. But again, we're going to offer a total solution, not a quick answer. So what we do, Anita, we find out what Anita's needs are. What's Anita's going forward, your 2-year need, your 5-year need, all the needs going forward, and then we evaluate what this is here for. Do you have beneficiaries still need this money? Are you still wanting to fund that? Possibly, and especially with these imploding policies, you're talking about $1,000 a month into a $100,000 life insurance policy.
I can't even fathom that.
A simple math will tell you after 7-8 years, it's not a great investment. So those type of situations, we have all different opportunities for people. We can put them in a fixed product, an immediate annuity, giving them income right away. We can do all types of different hybrid. Going back to the scenario, still, if they're healthy and insurable, what if we could take that old insurance policy, write it into a new insurance policy with a long-term care rider?
Fantastic.
So now that person has that still death benefit for his kids, grandkids, whatever he might want. But if something happens to him or her, he can attach that money into a long-term care rider. So now they've killed two birds with one stone. Instead of having that piece of paper that's in the junk drawer in their kitchen, now they know they have a living benefit, which is a long-term care rider, and they also have what they initially bought, which is a life insurance policy.
What do you call that?
That's just called a rider on these new products. It's a rider. It's called a living rider. And there's also what's called accelerated riders for terminal illness, the inability to perform 2 of the 6 daily functions of living. So what does that mean? That means, again, should that happen to you, you become sick, you have a stroke, you have that insurance policy you bought, you're going to leave your wife, your kids, your grandkids some money. Well, guess what happens? You're in a stroke. You might need to go in a facility. That policy is allowed on that rider to actually accelerate part of that death benefit. So you could take between $25,000 and $50,000 out of that $100,000 policy, use it for admittance to one of these facilities, come up with some money for some care you might want. All these new advanced medical procedures cost money above and beyond what an insurance company might want to pay. Co-pays at your hospital, whatever it might be. It's money to put in your hands. But again, it's a policy that wasn't around when you bought the first one. It is today.
That's what I was just going to ask. So this is something new. I mean, 10, 20 years ago, you couldn't get into your life insurance, could you?
Absolutely not.
So I guess what the insurance companies realized that there was a great need.
It's exactly right. And it's all part of the process. And it's part of the legality of the business. And the reason that they have come up with that is a simple reason. They are being forced to tell their clients when they call and say, you know what, Mr. Transamerica New York, I can't make these payments anymore. 5 years ago, the simple answer was, we'll send you surrender forms.
Okay, well, I want everyone to know how to get you. Rob Colson, 954-597-6430. 954-597-6430. Don't be foolish about your insurance. Call Rob Colson. The website is US Insurance Auditors.com. Gosh, Rob, you did a great job as usual. I always learn from you so much.
I'm glad and good to talk to you again, Anita.